So now we can start.
Good evening, the attendees and the erudite speaker for the day, Vijay sir, and a warm welcome to you all. You all know the importance of the compliances that are there and from various angles. And one of the important aspects is disclosure of accounting standards and their applicability in general, and very specifically the non-corporate entities. See, most of the times they are not disclosed. The accounting standards that we have followed are not disclosed, which is a standard, which is a mandatory requirement now. And under these circumstances, we thought it is a tax audit season, and also during the tax audit time also we are bound to follow these accounting standards, and also the disclosures are to be made. Even though we have been following all the accounting standards, we are not disclosing in many cases. That is the report we have with us. So taking that what is called cue, we at SIRC decided to have this 3-day series of webinar on the topics of non-corporate entities, the compliances that are required, the standards on accounting that is to be followed, and even though if followed, what is the disclosure that is to be made. So with this, we thought this is a very important topic for all of us, especially the small and medium practitioners who are doing the audit of non-corporate entities. So with this brief introduction, I very warmly welcome CAT Vijay sir. Thank you for accepting our request to be here today, sir. And also I warmly welcome all the delegates to this today's program. And this first day, it's only an overview of new classification of non-corporate entities and applicability of accounting standards. So this is being taken by CAT Vijay from Chennai. And before I hand over the proceedings to the speaker, I just take a minute to introduce the speaker to you with pleasure. Vijay TC is a qualified chartered accountant is in 2007, and also a cost accountant in 2005, a Bachelor of Commerce, University of Madras in 2002. Technical and other qualifications are Certified Information Systems Audit, administered by ICAI USA. His professional experience is Apollo Hospitals Primary Division Associate Vice President, Finance since 2021, Karra & Co. Partner 2011 to 20, Karra & Co. Audit Manager 2007 to 11, and 2004 to 7 as an article student. And extracurricular activities are managing committee member of the Society of Auditors, the oldest accounting body in India, faculty of accounting, professional accountant course conducted by the Society of Auditors, Chennai. Served as Vice Chairman of the Southern India Chartered Accountant Students Association during 2006-07. During his student days, he did not try his hand at the regional council and ahead. So with these words of warm welcome, I once again request the Mr. T.C. Vijay to take over the proceedings, and also thank Vijay sir for accepting our request to be here today to talk on this very important. Even though it looks so lucid, the compliances are not 100%, which is the expectation of the institute and the various quality review boards. With this, I hand over. Thank you.
Thank you, Pandrat, for the kind words of introduction. Before I begin, I'd like to thank SIRC of ICAI and Mr. Chinsami Ganesan for having given me this opportunity to talk on the overview of new classification of non-corporate entities and the applicability of the accounting standards for these entities. So without much ado, I'll get into the presentation. So today's topic is overview of the new classification of non-corporate entities and the applicability of the accounting standards for those entities. Basically, what are those classification that have been given by the Institute for non-corporate entities, and how the accounting standards are made applicable to those entities is what we are going to look at today. Now, my agenda for the day has been divided into 7 parts. One is what or who comprises a non-corporate entity. We'll discuss in brief about what is a non-corporate entity. Then what are the financial information needs of a non-corporate entity? Why an accounting standard should be there for a non-corporate entity? Then what are all the components or what comprises of a financial statements for non-corporate entities? And having said what comprises the financial statements of a non-corporate entity, what are all the items or components that are to be included in the financial statements of a non-corporate entities? Then comes the most important part for today's discussion, which will be the criteria for classification of non-corporate entities as per the definition given by the institute, which is basically nothing but level 1, 2, 3, and 4, with level 2, 3, and 4 being called as micro, small, medium enterprises. Then what are all the standards that are applicable based on the classification that we discussed during the course of the today's discussion? And finally, what is the format for financial statements? The format for financial statements, I may not be taking you through in full during today's agenda, because I believe that is a separate session which is being planned for how the financial statements are to be, and the model financial statements to be presented are discussed by Mr. Mohan Lavi in the upcoming sessions between tomorrow and day after. Now, we will move on to our first agenda, which is who or what comprises a non-corporate entity. The definition is very simple. As the name itself suggests, it's a non-corporate entity, which means all entities which are not a corporate. In simple words, entities which are business or professional entities, not all entities, basically entities which are business or professional entities, which has a profitable motive, are non-corporate entities. So the definition goes like this: all business or professional entities other than companies incorporated under Companies Act 2013 or erstwhile Companies Act 1956 and LLPs incorporated under LLP Act are considered as non-corporate entities. Basically, non-corporate entities includes sole proprietorship firms, partnership firms, whether they are registered or unregistered, trust, private trust or public trust, registered or unregistered, Hindu undivided families, AOPs, societies which are registered under any law, statutory corporation, autonomous bodies or authorities, what we describe as body of individuals for our tax filing purposes, and any form of organization that is engaged fully or partially in any business or profession activities unless they are fully charitable in nature, which means if an entity operates only for charitable purposes and not an iota of business or professional activities are involved, they are not covered under this definition. Now, having said what are the non-corporate entities, what is the need for an accounting standard for a non-corporate entity? Why is that an accounting standard is important for a non-corporate entity? Now, if you take the economy, we might feel that much of the economic activity is revolving around the corporate entities, but that is not true, because most of those corporate entities are supported in the background by these non-corporate entities. So in the recent past, when entities started growing, the extent and size of the economic and financial activities of the non-corporate entities have also grown over a period of time. And when an entity, when a sector grows, and obviously the sector generates or gathers importance, and for a sector that gathers importance, people will be looking at those entities for various aspects. for looking at how the sector grows or looking at how the entity grows. Now, for all those information, financial statements forms the backbone for those things. Now, for anyone to do a financial planning, to do an analysis, or if I have to benchmark against an entity, or for a decision making, financial statements are the backbone. Now, that is where the importance of a financial information of non-corporate entity comes in. So, the users of the financial statements, it can be anyone, like the present or potential investors into the entity, or its own employees, or basically the lenders, or statutory authorities like the income tax, the GST, or sometimes even the enforcement directorate or RBI. These are people, when they come and look at an corporate, the first point that they start with will be a financial statement. I don't think they'll be asking for anything else. They come, ask for, where is your last year's financial statements? Where is your balance sheet P&L? So any financial information can be the starting point for someone who's outside the organization is the financial statement. And that is why the accounting standard for non-corporate entities becomes important. Now, one person can take one mode of recognizing a revenue. The other person can do a completely different thing within the same entity size. For example, one sole proprietor could do revenue recognition on one basis. The other sole proprietor who is into the same business can do a totally different method. Now, if someone has to take an informed decision by comparing these two, they should have a uniform accounting practice. Now, a uniform accounting practice can be implemented by adoption of a standard form of accounting that can be done. Now, that is where the accounting standards were introduced by the Institute of Chartered Accountants of India. And basically, to implement this, they have given what are all the criteria based on which these accounting standards should be implemented. So now we have said that financial statements forms the base for these entities, and these entities are supposed to follow the accounting standards for the preparation of the financial statements. Now, what constitutes a financial statements? Now, actually a word of disclaimer before I dwell in detail into the entire presentation. Please don't expect anything new coming out of these entire presentation. Actually, a lot of these accounting standards, if I have to put it in a comparative basis, almost 60 to 70% of these accounting standards are already being used by non-corporate entities on a day-to-day basis. It is not something new that the non-corporate entities are going to adopt as an accounting standard or an accounting policy now. All these have been in the form of practices already in place. Okay, having said that, if it is already there, why there is a sudden hue and cry about adoption of accounting standards, all those things? All these were being adopted by the non-corporate entities, but they were not part of the disclosure. Like it was not disclosed, or it was not told to the public at large, or the users of the financial statements, basically where we are talking about, that the financial statements are prepared in compliance with so-and-so standards, or are prepared in such a manner. Basically, what was lacking was the disclosure of what comprises in the preparation of these financial statements. What is the method that I have used for each of the items in these financial statements? So the purpose of this 3 days seminar, or the purpose of this 3 days study meeting, is basically to ensure that we start disclosing what we are doing. It is not that we are going to do something totally different and then that will come up as an additional job. No, the only additional thing that we are going to do is to document and tell people outside that, yes, I have been following these things, and this is how it is being followed. Basically, a definition or a system where we will be giving what are all the accounting standards that I have followed by way of an accounting policies disclosure, and how it is being followed by way of a disclosure with respect to each of the accounting standards. Now, with this disclaimer, again, we'll get into the subject as such. Now, what comprises the financial statements? As you all know, it comprises of basically 4 elements, which is nothing but the balance sheet, statement of profit and loss account, cash flow statement, and notes and other explanatory statements that form part of the financial statements. Now, if you look at it, no, all these components are interrelated. They do not, if you take each one of the component and see it in isolation, it doesn't make sense. So all these components as a whole makes a financial statement, and each of the component reflects different aspects of the same transaction or other events. For example, if we take sale, now my profit and loss account gives what is my total sale and what is the profit that I make out of a sale. Whereas my balance sheet gives out of the sale how much I have collected or how much or what is pending to be collected. And when I go to a cash flow statement, though I claim that my total sales is so much, how much of it I have collected in cash and how much of it I have utilized. So each and every statement in a financial statement, or each and every document that goes into a financial statement or a component that goes into a financial statement has a specific purpose. And if you put all together, it gives us a meaningful picture, which can be used by the various stakeholders for their decision making or benchmarking or whatever is the purpose that they are looking at the financial statements. These are general definition of a financial statements. We can skip this one. Basically, the financial position of an entity, what we call as a financial position of an entity, is like we would like to see out of its past, what are all the economic resources that the entity is controlling, what its financial structure and its liquidity and solvency looks like, and how is it capable of adapting to the changes in the environment in which it is operating. So basically, these are given by various ones, like what are the economic resources that are controlled by the entity or the financial position. This is nothing but the balance sheet that we call. What is the performance of an entity over a period of time? This is nothing but the profit and loss account and that we prepare. And what are the cash flows of an entity that is for a period? Now, these are given in the cash flow statements of the entity. Now, having said this, now what each should disclose. Now, if I take my balance sheet of a non-corporate entity, what it should disclose. Nothing new. This is what has been in place already. The balance sheet should disclose basically nothing but an asset, liability, and an equity. Very simple. Assets, liabilities, and whatever is the residual that will be given as a equity. Now, the accounting standard tells you how to recognize an asset or when to recognize an asset, how to recognize a liability or how to account for a liability or when to account for a liability. These are basically what gets defined in an accounting standard. Similarly, profit and loss account is very simple. It is an element that is directly related to measurement of a profit or loss, which are nothing but outcome of the income and expenses that are incurred by the enterprise over a period of time. Similarly, cash flow statements. Now, cash flow statements historically has been prepared on a basis which has changed, and we basically want the cash flow statements to give us a classification based on three main aspects, which are nothing but what are the operating cash flows that the entity has, what are all the investing cash flow that the entity has, and what are all the financing. Basically, to understand from a perspective as to what the entity is capable of or what the entity has made out of its operation activities or out of its financing activities, and how those are getting invested or how those are getting financed. Now, having said that, so basically we have said that the financial statements comprises of what elements are there and why we require an accounting standard for a non-corporate entity. Now, having said that, I cannot go and apply an accounting standard for all the entities as it is. For example, if you take a shop which does about 200 crores turnover, cannot have the same set of accounting standards or a same set of rules which is applicable to a small kirana vendor who does basically about 5-6 crores per annum. There should be a criteria which you apply. Now, the institute with all its wisdom has come up with a classification of these entities, basically to say that entities which are large and whose financial information will have an impact on the economy directly should follow a set of standards, and entities which are slightly lesser than that will follow the same standards with certain exceptions, so on and so forth, up to which a level where there are micro or very small entities which are required to follow only basic accounting standards, which will give the required information without putting any stress on the system. Like if you apply all the accounting standards to all the entities like micro, small entities, now the cost of compliance for them will rise. So the purpose of classification into various levels, which we are going to see over the next few slides, is to ensure that the entities find it easy or economically viable for them to implement these standards, and the outcome will also have an impact or a positive impact both on the financial statements of the entity and all the users of the financial statements. Now, when we talk about classification, the institute basically classifies the non-corporate entities for the purpose of applicability of accounting standards into 4 categories: level 1, level 2, level 3, and level 4. Now here level 1 entities are the big or large entities, and level 2, 3, and 4 are respectively smaller entities, with level 4 being the smallest. And these are the entities that are referred to as micro, small, and medium enterprises, MSMEs. Now, how do I classify these entities? Now, there are specific rules or guidances based on which the entities are classified as level 1, level 2, and level each of these levels. Now, level 1 entities are entities that has their securities listed or in the process of listing on any stock exchange, whether it is in India or outside India. Banks, financial institutions, and entities carrying on insurance business. Before I go to 2 and 3, 3 and forward, generally we may not find a non-corporate entity getting listed, because basically to the extent that we see, listing is generally allowed only for corporate entities. Now, securities includes not only share capital, not only equity share capital, it equally involves like debentures or any debt instruments that can be listed. But even there are certain criteria which allows only predominantly the corporates to get listed. So in our practical exposure, we may not see level 1 entities being covered because of the first 2 conditions. Now, the next condition or the next criteria is all entities engaged in commercial, industrial, or business activities. Why the commercial, industrial, or business activity is important is any entity which does not exist for the purpose of profit, or its entire activity is not commercial, it is purely charitable, then none of this classification will apply and the accounting standards will not apply to those entities. Hence, entities who are engaged in commercial, industrial, business activity, whose turnover, excluding other income, exceeds 250 crores in the immediately preceding accounting year, will be classified as level 1 entities. Then again, the entities in the commercial, industrial, business activities who have borrowings, including public deposits, in excess of rupees 50 crores at any time during the immediately preceding accounting year. Now, the previous one is a cumulative condition where for the entire year put together, the total turnover should exceed 250 crores. It is not 250 crores and above, it is above 250 crores. So if someone has exactly 250 crores, it will still not be classified as level 1. Whereas for the purpose of borrowings, it is not as at the end of the financial year, it is at any time during the preceding accounting year. Which means if an entity has borrowed more than 50 crores and then repaid it within the financial year also, it will become a level 1 entity because of the classification that is being prescribed. Or holding and subsidiary entities of any of the above. Again, holding and subsidiary relationship in a non-corporate entity are very rare to see. Now, all these conditions are exclusive conditions, which means it is not a cumulative condition. Each condition are to be applied in its as separate one. Like there can be an entity whose turnover exceeds 250 crores, but still may not have borrowings at all. Even in that case, it will become a level 1 entity.
Sir, Vijay sir, 1 second, sir.
Yes,
sir,
sir.
Can we define borrowing? Or is it defined, sir? What type of borrowings?
All borrowings, sir, including public deposit. See, they've said anything. Borrowings does not restrict itself to only from public financial institutions or banks. Even if there are borrowings within the entity from another entity, like ICDs, not an ICD will not come in a corporate thing. So even if it is whatever is classified as a loan will come. So even if the proprietor has given a loan, which is not from his pocket, will all covered as borrowings only.
Okay.
Now, the purpose is wherever there are borrowings, it will predominantly include access to public funds, which means there'll be public money involved. So hence, they want these entities to be covered under this criteria. So the participants are free to ask queries as we go along, if they have any doubts. So how does it moderated, sir? Okay, so now we will go on to level 2 entities. Level 2 entities are basically entities which are not level 1 entities, but who has a turnover criteria. Like the turnover now here is where it exceeds rupees 50 crores, but does not exceed 250 crores. So any entity between the turnover region of 50 to 250 crores in the immediately preceding accounting year will be classified as level 2 entities. Similarly, for the borrowings, the limit is between 10 crore and 50 crore. It does exceeds 10 crores, but does not exceed 50 crores. Now, level 3, it's the same, which does not fall into level 1 or level 2, where the turnover is between 10 crore to 50 crores. Borrowings is between 2 crores and 10 crores. Then whatever is the holding and subsidiaries of these entities. Level 4 are very simple. Entities that does not fall into any of the other categories, or in simple words, we can say that entities whose turnover is up to 10 crore in the previous financial year, and entities who does not have a borrowing up to 2 crores will be classified as level 4 entities. I thought a small summary might help. Now, level 4 entities are where sales are less than or equal to 10 crores, borrowings are less than or equal to 2 crores. Level 3 is where sales greater than 10 crores, but less than or equal to 50 crores. Borrowing is greater than 2 crores, less than or equal to 10 crores. Level 2 will be sales more than 50 crores, but less than or equal to 250 crores. Borrowing of more than 10 crores, but less than or equal to 50 crores. Level 1 entities will be where sales are greater than 250 crores and borrowing are more than 50 crores. Now, we might have certain questions related to these applicability. So we will go as such. The institute has itself clarified in its announcement a lot of those clarifications. So what are all the disclosure requirements that the institute talks about on the classification? Now, whether I'm a level 1, level 2, level 3 entity, how do I disclose it in my financial statement? The announcement warrants us to say that whether I have availed any of the exemptions given in the applicability of the accounting standards, which we are going to discuss in the course, then I need to disclose 2 facts. One, what is the level of my MSME status, whether I'm a level 1, level 2 or level 3 enterprise, and what are all the exemptions that I have availed. Now, if an entity has the applicability for the entity comes only from financial year 2021-22 for the first time. Now, before that, the entity did not meet any of the criteria. the entity now meets the criteria. So does it mean like the requirement of Ind AS, I go and change the previous year figures, or should I apply it from the point forward? Now, the announcement is very clear that these accounting standards will be applied prospectively, which means if as on 31st March 2021, I meet any of the criteria for being a level 2 enterprise, let's assume, then I will apply the standards applicable for level 2 enterprise starting from 1/4/2021 and will not go back for restating the numbers that are already there. So that is point number 2. The next one, the reverse. Now, all along, I have been a level 1 entity. But suddenly, as on 31st March 2022 or 31st March 2021, we'll take, because that will be the applicable year for us now if you are filing the returns for the current year. 31st March 2021, because of whatever is the aspect, my sales have come down below 250 crores and I don't have borrowings. Now, from level 1, I have become a level 2 enterprise according to the classification given by the institute. Am I allowed to suddenly take all the exemptions that are given for a level 2 enterprise and say that I'm no longer a level 1 enterprise and I will not follow these accounting standards? The institute says no. It might be a temporary phase, so you can avail any of the exemptions for a lower level. Let's say from level 1, you are moving to level 2, 3, or 4, or from level 2, you are moving down. All these are applicable when you are moving down. When I'm moving up, it becomes applicable immediately. But when I'm moving down, I should move down and remain the category for 2 consecutive years, and then only I can avail the exemption. So for example, if in FY21, I don't meet the criteria, my sales is less than 250 crores. Earlier, I was a level 1 enterprise. FY21, I was less than 250 crores. FY22, also I was less than 250 crores. Then for the financial year 22-23, you can avail all those exemptions by giving a suitable disclosure. This is what it means. Like an entity has been covered in level 1 and subsequently ceases to be covered and gets into level 2, 3, or 4, will not qualify for exemption relaxation. He ceases to be covered in level 1 for 2 consecutive years. This applies for level 2 and 3 simultaneously. Now, unlike Indian accounting standard, Ind AS, here the institute gives us an option to take certain exceptions alone and not take certain exemptions available. See, there are a lot of exemptions and relaxations which are given by the standards, or which are given. There are a list of standards which are not applicable. For example, if we take, there are a lot of exemptions that are given with respect to the employee benefit standards. And even within the employee benefit standards, they have another classification, not only with respect to level 2, 3, 4. They also have an exemption based on what is the number of employees that the entity has. But now, if an entity feels that irrespective of my size of employees or irrespective of my organization size, I would like to comply in full with AS 15 requirements so that it gives me a better picture, they are free to do so and disclose the fact that with respect to the exemptions given, I'm not availing exemptions given for AS 15 employee benefits alone. This is allowed in accounting standards or IGAP, which is not allowed under Ind AS. In Ind AS, you have to either apply everything in full or not apply at all. There is no via media, like where I can pick and choose. But having said that, Institute gives us a word of caution saying that this exemption or opting for availing certain exemptions, or opting for not availing certain exemptions shall not be permitted to mislead any person or public. It should be done for giving a better picture to the public or better picture to the users of the financial statements, but not for defrauding or hiding some of the aspects. Now, if you ask me in general, how do I ensure whether a particular exemption, if he is availing, or a particular exemption, if someone is not availing, how do I classify whether it will lead to any whether it will mislead any person or public? It's a call which a professional has to take. And we all know whether that particular item is being done for what purpose, based on which we can take the call. So basically, this is what, like, to sum up, an entity which falls into a lower category, climbing up and getting to an upper category, has to apply all the accounting standards applicable for that level. From that point forward, it need not apply it from a previous financial year. It has to apply from the financial year in which it becomes applicable. Whereas if the entity climbs down the ladder, which means from a level 1, it comes down to level 2 or 3 or so on and so forth, it can apply the exemptions only after being in the lower level for 2 consecutive years. Level 2, 3, 4 entities which have a lot of exemptions or relaxations in terms of applicability of the accounting standards can pick and choose what are all the relaxations or what are all the exemptions that they would like to avail. They need not avail all the exemptions. They can say that I will not take any of the exemptions and do it, or they can choose which are all the exemptions that they would like to avail and which are all not to avail. Now, having said that, we will move on to what are all the exemptions or what are all the standards that are applicable. In very simple words, all accounting standards starting from AS1 to AS29, excepting AS8, which has been withdrawn. All the 28 accounting standards are applicable to a level 1 entity in its entirety. There are no exemptions available for a level 1 entity. A level 1 entity has to apply all the accounting standards, irrespective of the all the accounting standards. There are no exemptions available. Now, there is only one thing which I wanted to discuss before we move on further. We have trust, not charitable institution, not for profit organizations. Now, as we discussed earlier, there is a trust which does only a small portion of commercial activity, which accounts for, let's say, less than 1% of the total activity of the trust, but 99% of the trust does only non-profit activities only. Whether the accounting standards will be applicable to the entity or to the trust or not, the answer is yes, because there is a technical guide that was issued by the Institute of Chartered Accountants of India for which talked about the accounting for charitable trust, where it is very clearly said that the accounting standards formulated by ICAI do not apply to an NPO or not-for-profit organization if no part of the activity of such entity is commercial, industrial, or business in nature. The standard would apply even if a very small portion of the activity is considered to be a commercial, industrial, or business in nature. So, as I was discussing, even if a very small portion of a trust or a charitable institution's activity is considered to be for profit or a business or a professional venture, it would apply for all its activities. It cannot say that I'll apply only for that particular activity. The accounting standard will become applicable for the financial statements as a whole. Now, what are all the applicable accounting standards for each of these entities? As I said, I'm not given level 1 entity here because for level 1 entity, all the standards are applicable in its entirety. There are no exemptions available. Now for level 2, 3, and 4, the following are the accounting standards that are applicable. Now, when we take AS1, it is applicable to all the entities. Level 2, 3, and 4, there are no exemptions. Basically, why AS1 is applicable to all is a very simple aspect that AS1 talks about disclosure of accounting policies, wherein whatever is the accounting standard that is applicable to me, I will have to disclose how I'm complying with those, or what are all the policies that I have formulated to comply with those accounting standards, and what are all the policies that I have for accounting these things. So it is basically nothing but a disclosure of my policies that I have followed, and any entity will have to disclose that unless it discloses, the users will not be able to understand why an entity followed such a, or what the entity has done in the preparation of the financial statement. Now, again, next AS2, which is on inventories, again is applicable for all the entities, because if the entity has inventory, then it has to necessarily apply AS2 for valuation and accounting. Similarly, if you take AS4, AS5, which is again on profit and loss account statements, are applicable in its entirety. There are no exemptions available. 7 on construction contracts, 9 on revenue recognition, again is applicable in its entirety, because the basis for any entity is, as we said, the entity is engaged in commercial activity. So any entity has to disclose how it is recognizing its revenue, which is a more important aspect. So it is applicable in its entirety. Now, when it comes to accounting standard 10, level 2 entities are supposed to apply it in its full, whereas level 3 and level 4 has to apply the accounting standard, except for the disclosures exemption. So there are certain disclosures that are required under AS 10, which level 3 and level 4 entities are exempt from. So basically, they will have to follow the accounting standard, but they are given an exemptions only from the disclosure requirement, which means in very layman terms, if I have to talk, for the preparation of the balance sheet, I'll follow the accounting standard. For the preparation of the P&L, I'll follow the accounting standard. For the preparation of my accounting, my disclosure of my accounting policies, I'll follow the standard. Only in the notes to accounts where I'll have related disclosures for a particular standard will not be applicable. Same as the case of accounting for foreign exchange losses or gains. Again, level 2 entities have to apply the standard in full, including disclosures, whereas level 3 and 4 need not apply these standards for disclosure aspects alone. Then accounting standard 12 on government grants applies in its entirety, because the standard by itself is a very simple standard, and it only talks about how an accounting treatment should be given for a government grant that is received by any entity. So that is applicable in its full. AS 13 on investments are applicable for level 2 and level 3. Level 4, again, only a disclosure exemption is given. Now 14, though we are 14 for the time being, we'll park it, not discuss that. Then AS 15 for level 2, level 3 and level 4 entities are applicable with a lot of exemptions being given. In fact, if you see the earlier exemptions and all, that is for AS 10, 11 and AS 13, the standards were either made applicable or with only disclosure exemptions, whereas only from AS 15, it was made applicable with a lot of exemptions being given. This is because the institute took a practical view as to application of the AS 15. For example, there might be entities which might be working with a few staff, like they might operate with some 20, 30 staff. Predominantly the micro, small and medium enterprises, if we look at, will not have an employee strength of more than 30, 40 employees on an average, or max 50 employees. So the institute took a lenient view and said, now I don't want to impose a standard like AS 15 compliance to be a burden on these entities. So I will give them certain exemptions, even with a specific part of the standard. Now, whatever is the standard that talks about employee liabilities which are current, which are incurred for the period, it is applicable in its entirety. For example, salaries for the year, the whatever is the perquisites or whatever is the allowances that are given for the year will be recognized as it is. But wherever it involves actuarial signs, now I don't want the entities to be burdened with those things. There they made another classification saying that entities which had more than 50 employees and entities which have less than 50 employees, and have accordingly given exemptions which are like, they need not go for an actuarial valuation, but they can do a realistic valuation based on their own data that is available. and they need not go for a discounting which is required when we go to an actuarial valuation of these liabilities, and they need not calculate or pay have any provision made for long-term employee benefits which are other than gratuity and long-term compensated absences. Now, next AS 16, which is on borrowing costs, is applicable in its entirety because it basically talks about how do we account for a borrowing cost, which basically involves a very important aspect of what part of the borrowing cost can be capitalized and what has to be expensed off. And since this is a very important aspect, which will give distorting results if it is not followed by all the entities, because someone can go and capitalize something which is in revenue or bring to revenue what is a capital, vice versa. So AS 16 is made applicable in its entirety. So there is no exemption for any of the entities here. Now, AS 17 is not applicable in its entirety because it's only on the segments. Now, AS 18, which is applicable only to a level 2 entity, because basically a related party transaction which the entity will have a positive edge to how do we call, like generally related party disclosures are given in the balance sheet to ensure that the related party transactions are carried out at arm's length. Now, if someone has a related party, is he at a influencing position where he can influence the transaction with a related party, wherein it results in a benefit, or he moves the result out of the entity to a third party? This is the underlying one of the major idea of having a related party disclosures. Now, level 3 and level 4 entities may not have that much of a capacity or a capability of influencing, and hence it is not applicable. Again, these are my own interpretation or my own thought process saying that why it may not be made applicable. These are not in the print, or these are not in the notifications that is given by the ICAI. Now, AS 19, again, it is applicable only with disclosure exemptions. AS 20 basically will not apply because these are EPS. There is no EPS for a entity is concerned. 21 talks about consolidated financial statements, which generally will not be applicable for non-corporate entities. AS 22, level 2 and level 3 entities are, it is applicable in full, whereas in level 4 entities, it is applicable only to the extent which it talks about current tax, which means level 4 entities need not have deferred tax applicability. Now again, AS 23 related to accounting for consolidation related things is not applicable. AS 24 on discontinued operations again is applicable only to level 2 enterprise, not for level 3 and level 4. AS 25 again on JVs is not applicable. AS 26 on intangible assets are applicable to level 2 and level 3 enterprises. Level 4, it is applicable as far as the accounting for intangibles are concerned, but there are a lot of disclosure exemptions which are available. AS 27 again is not applicable to any of these enterprises. AS 28 and 29. 28 is not applicable in its entirety to level 4 enterprises, whereas to level 2 and level 3 enterprises, I need to test these enterprises for impairment and do an impairment if it is necessary. But there are disclosure exemptions, or there are exemptions in terms of how do I calculate whether an asset is impaired or not. So these are given in detail. Then for AS 29, which is provision, contingent assets and contingent liabilities, these talk about when do you recognize a provision and what do you classify as a contingent assets or a contingent liability. The criteria for the recognition is applicable to those entities, whereas the disclosure is not applicable to any of those entities. Now, if you look at it, level 4 enterprises, if you look at it, what are all the applicable standards if we have? If you remember, towards the beginning of the presentation, I started by saying that most of these things we are already doing. The only thing that we don't have is a disclosure that we are not making. So barring AS1, which talks about disclosure of the accounting policies, if you look at it, AS2, accounting for inventories, most of the entities are already doing it. And as when we do an audit, inventory is one of the major items that we look into it. AS4, AS5 applies for the profit and loss account for the period, post balance sheet events, all these aspects, it's already covered under our audit. Only thing is that we were not disclosing it as a part. Now, again, AS9 on revenue recognition. Every single profit and loss account revolves around revenue, and it was always tested. AS10, again on fixed assets. It has been complied in its full because we will see whatever is capitalized, whether the capitalization of the fixed assets was under the correct head or not, and whether what are all the expenses that needs to be capitalized only are capitalized or not. All these things were already been accounted for. Now AS11 on foreign exchange, to the extent which are applicable for any of these entities, we have already been complying with these requirements in its entirety. AS12 government grants, wherever government grant is applicable, we were accounting it for it. Similarly, on borrowing cost, only the cost which had to be capitalized were capitalized. What are all the borrowing costs that needs to be expensed of has been expensed of. Now, you can vouch for yourself that we have been following all these standards already, and nothing new is coming today. Only part that is coming new is to document and to disclose in public that, yes, I have followed these standards in this manner and this is my result. I have followed the standards in this manner is what is defined in my accounting policies. And the results are the disclosures that we give. So basically, I reiterate, and I've been repeating this many times again, that most of these standards are already applied by us in terms of the recognition and measurement. We are not following the disclosure aspects of it. Now, as I was talking, I was saying that AS14 will take up late. So this is the reason. Generally, non-corporate entities, there are no such transaction that gets covered under AS14, which is accounting for amalgamations, because there is no amalgamation. Because non-corporate entities which are level 4, there may not be any merger sort of a thing. But in case if there are a merger, the companies are supposed to apply the 11th standard and account for it. Now, consolidated financial statements, accounting for investment in associates and joint ventures, interim financial reporting. Sorry, AS25 was interim financial reporting. I have mentioned it as JVs earlier. So interim financial reporting are predominantly not applicable for a non-corporate entity, and hence it is made as not applicable. But if for some purposes an entity wants to prepare a consolidated financial statement, let's say a partnership firm has is a partner in another entity and wants to consolidate it for any of the purposes, then the 11th provisions of the standards are to be applied, and the non-corporate entity can elect to prepare and present in the manner as required under the standard. But in general, these are not applicable, in the sense, even if I have a controlling stake in another entity, unless a law mandates me to prepare a consolidated financial statements, AS21 will not be applicable to a non-corporate entity. Unlike companies, where a company, once if it holds a controlling stake, it is mandated by the Companies Act to prepare consolidated financial statements. And hence AS21 will automatically apply to companies. Whereas here, there is no mandate for a non-corporate entity to prepare consolidated financial statements unless there is a specific requirement under any law for the time being enforced, or the company or the non-corporate entity on its own wants to apply. So, wanted to take up specific exemption, like I was talking to you regarding the AS15 exemption. So this is what is the text of those exemptions. So it basically categorizes the level 2 and level 3 entities as persons employed more than 50 and less than 50, and gives various exemptions. Now, basically, if you look at the exemptions, it is nothing but a short-term compensated accumulate, the leave encashment that we have. If it is non-vesting, then entities which have less than 50 employees are exempt from applying those standards pertaining to this short-term compensated absences. Then they are not required to discount the amounts which fall due for more than 12 months after the balance sheet date. So the discounting principles are not applicable to them. Then whatever was the defined benefit plan, the accrued liability has to be done by way of a actuarial valuation. But the entities which meet these criteria of having less than 50 employees need not do a actuarial valuation, but they can assume a more comprehensive method. Like, what is the amount that would become payable if all the employees retire as on the balance sheet date? They can make a calculation, and to that extent, they can make a provision so that all the hit for the gratuity or the gratuity payable to them will not hit on the date of the balance sheet. So the standard itself says they can do any method based on the assumption that such benefits are payable to the employees at the end of the accounting year. Now, these, if the company employs, the company has to make a suitable disclosure in their financial statements. So I have come to the almost end of my presentation. Now I can take up questions. I see there are some questions already. I'll start taking up those questions one by one. So there's a question which says that listed company has taken loan from unlisted companies. How you treat this loan in this case? Now, when I talked about borrowings, the borrowings I referred to is from the angle of the liability side of the entity to which we are referring to. So if a non-corporate entity has given a loan to a listed entity, which is an asset to the non-corporate entity, this will not apply, or this will not come into my criteria for classifying it as level 1, level 2, or level 3, because it is only an asset, whereas my classification is based only on my turnover or borrowings or being listed or unlisted. So in my opinion, these are not the loan that we are talking about from an unlisted company to a listed company will not make the taken loan from unlisted companies. I presume the person wanted to ask unlisted non-corporate entities. If it is from companies, then the entire thing is not applicable, because for companies, the accounting standards are applicable in its full based on the criteria given by the accounting standard rules specified under Companies Act. It will not come here. Whether both the conditions to be satisfied or any one conditions to be satisfied. All the conditions that are mentioned there are not cumulative. These are conditions that are to be seen as single conditions. For example, if a company has only more than 250 crores of turnover, but still has no borrowings, it will still be classified as a level 1 enterprise. So to answer in short, all the conditions to be satisfied, any one condition to be satisfied. It is not that all the conditions cumulatively to be satisfied. Now, again, there's a question on how Ind AS amounts are considered. The question can be more clear. I'm not able to understand what is Ind AS amounts. If the question is related to Ind AS applicability, whatever discussions that we had right now is restricted to the applicability of the standards that are issued by Institute of Chartered Accountants of India, whereas the Ind AS that we are talking about has a different set of applicability, and currently Ind AS standards are applicable to corporates and non-banking financial companies. So applicability of Ind AS is not a question here. How bank guarantees are to be treated. If the question on bank guarantee is related to whether bank guarantees are to be treated as borrowings, in my opinion, bank guarantees will not be considered as a borrowing for the purpose of treating or for the purpose of evaluating whether the non-corporate entity will be covered as a level 1, level 2, level 3 enterprise, because unless and until the guarantee translates into a liability and sits in the financial statement as a liability, it will not be classified as a borrowing, and hence it will not be treated as a borrowing. So any more questions, sir? Are they allowed to unmute and ask questions, or questions are only
Yes,
through?
yes.
We have given option to unmute themselves, sir. So anybody can unmute and ask. Sudhakar sir, you unmute yourself. You can ask. They can unmute and ask. They can put it in the chat box also.
See, basically, one more thing which I wanted to share is there is a good publication or a notification by a publication by the institute. I will share that for a moment. So the institute has come up with a technical guide on the financial statements of non-corporate entities, which is a very useful publication by the institute, where it talks in detail about the applicability of these financial statements, how these classification are done. And in fact, the technical guide also gives you a sample financial statements. So I can take you through the format of the financial statements. If there are no questions, I will so the institute has even come up with an illustrative financial statement, which is there. So like Schedule 3, which talks about the format and the content of a financial statement. For a non-corporate entity, the institute has come up with a format of what constitutes, or what is the format that is to be employed for the purpose of preparation of the financial statement. So basically, it does not, it starts with the equity and liabilities, which is nothing but in a corporate jargon, what we call as the share capital. So it is here called as owner's fund, which is basically classified as owner's capital and reserves and surplus, which is nothing but the accumulated thing. And as applicable to all the financial statements, we are required to give the figures as at the end of the current reporting period, plus corresponding figure of the previous reporting period. So it starts with equity. And liabilities, basically the non-current and current classification is again there here. And they have also brought in the change that was introduced in the Schedule 3 format with respect to outstandings to MSMEs. The same is being brought here in the financial statement formats. Then again, assets are basically classified into current and non-current. Non-current being my predominantly my fixed assets and investments. Then other non-current current assets, which will be my current investments, inventory, trade receivables, cash and bank, cash, bank, and advances. Now, similar to what we have in Schedule 3, we have instructions that are given for each and every item that is there. We will not be going through the entire thing. I'll give you a brief of 1 or 2 items. Classifying into current and non-current, similar to what we have in a corporate financial statements. Even here, the operating cycle will be the operating cycle of the particular industry or the particular sector to which the non-corporate entity belongs. If there are no particular thing or it is not to be identified, then a period of 12 months is the generally assumed operating cycle. Now, liability we have discussed, so I'm not getting into those. What are all the specific items alone, we will take it up. So, similar to our capital, share capital disclosure that we have, where it requires us to talk about what are all the issues that are made during the year, and then the closing reconciliation basically between the opening owners funds and the closing owner fund. Here there is a disclosure which has taken into account what are all unique for a non-corporate entity, where there have been opening balance, what are all the capital introduced. Then if there are remuneration interests which are being charged to the capital instead of being withdrawn, or if there are withdrawals which are charged, generally the capital and the current account will be credited with the remuneration, and as and when funds are available, they'll be withdrawn. So the reconciliation needs to be given. That is one takeoff from the regular corporate accounting that we have. And in general, these disclosures may not form part of any of the entities' financials, non-corporate entities' financial statements in the present day. So this is a very important takeoff from the current disclosures that we have. Generally, we give only the owner's capital with a reconciliation of the current year profit. But here, the institute requires that the entity has to give a complete reconciliation showing what are all the additions and what are all the deletions that are there in the same. Now, all these are the general one. Long-term borrowings, we know there is nothing in specific on those long-term borrowings. Trade payables, again, the same, where major disclosure in terms of what is due to micro, small, and medium enterprises are to be disclosed separately. Now, they've used the same word as property, plant, and equipment because the revised accounting standard talks about property, plant, and equipment and not fixed assets anymore. Then the classification of tangible, intangible assets. Then investments. Again, investments, they've classified and they have borrowed the current Schedule 3 wordings as to investment property, investment in equity, shares, preference shares. Same classification which are there for a corporate entity, they made it applicable. In short, if we look at the balance sheet and P&L per se, I would say that if we apply all the accounting standards and apply it in its full and have the disclosures, we may not be able to tell a difference between a corporate financial statements and a non-corporate financial statements. It will look more or less the same, except for the fact that there will be certain change in the names, like where we would use share capital or equity share capital. here we'll be using as owner's funds or owner's capital.
Hello. Good evening. That's right.
Is there a doubt or someone
Actually.
wants to? I believe someone. Okay, I think that's a.
They have unknowingly unmuted themselves, sir. Since everyone has given unmute types.
Yeah, that's fine. I think someone has accidentally unmuted. That's we'll proceed. So I'm just rushing through these financial statement disclosures because you have a specific session fully on the preparation and the presentation of the financial statement. Now again on this balance sheet, as I said, contingent liabilities are to be disclosed to the extent it is applicable. There are applicability exemptions that are given for level 3 and level 4 entities. So to that extent, they may avail the exemptions as it is applicable to them. Now, format of statement of profit and loss account, it is very simple. Now, the word statement of profit and loss account or income and expenditure can be used vice versa, because if it is a not-for-profit entity or a trust, then we may have to use income and expenditure account. So basically, this might undergo a slight change when it comes to income and expenditure from this one. Now, the deferred, whatever is given here is only an indicative format. If there are certain elements which are not applicable, for example, for a level 4 enterprise, deferred tax is not applicable at all. So they can accordingly not have the disclosure at all. There's no need to put deferred tax and say nil. They need not have deferred tax at all because they will be taking those exemptions. All these are predominantly a takeoff from the earlier one. And as I was saying, this technical guide gives all part of, in fact, my entire presentation is a copy paste of the portions from these technical guide. What I presented to you over the last 45-50 minutes is nothing but the is the technical summary of the brief summary of the technical guide, which I could read and then give it to you in a brief format. My personal request to you all is to download this. This is available for download from the institute website. Please download this, read it its entirety. Though it is an 80-page document, it may not take more than 1.5 to 2 hours for someone to read it in its entirety and understand the concept. This will give us a complete picture of applicability of the standards and how to present a financial statements for a non-corporate entities and what are all the standards that are applicable and that are not applicable. This gives a complete comprehensive view of whatever was the today's topic. In fact, I felt the today's topic was basically arising out of this technical guide. So basically, I've come to the end of the presentation. So any
more questions? Selva?
Yeah, I have
Yes,
one
sir.
question.
So
in
one
the
question in chat box, yes, sir.
Yeah, so when disclosure reporting becomes applicable for a non-corporate entity for the first time with respect to a particular standard, whether figures, amounts for the last financial year is also required to be reported in the disclosure. The requirement per se, but the applicability per se is for the accounting standards starting from now for the future periods. So there is no requirement for them to go back and apply the standard. So the simple answer is no. There is no disclosure of the last financial year amount to be disclosed if the standard becomes applicable for the first time. Applicability of a standard will only be prospective. It is not retrospective. Then there is a question from Naveen Kumar, where rounding off is applicable to non-corporate entities in the financial statements. Yes, rounding off is applicable. Probably I skipped it fast when I was scrolling through. So rounding off is still applicable. I will show the same rounding off is applicable here. So here it is. Depending on the total income of the non-corporate entity, the figures appearing in the financial statements may be rounded off. So up to 100 crore rupees and more than 100 crore rupees. So if it exceeds 100 crores, the rounding off will be applicable in lakhs, millions, and crores. But these are maybe conditions, so it is not that you have to apply it. But for a better financial, for better understanding of the financial, when someone has a more than 100 crore turnover, if the figures are presented in lakhs, it gives a meaning. So yes, rounding off is applicable. If there are any more questions, I'm open to take it.
Selva,
Sir, tell me, sir. So
any
those were
more
the questions.
questions, or shall we
No, sir.
close?
The audience can unmute and or else I can put it in chat box. There's one question.
Yeah.
Again came up in the question box, sir. Whether both the conditions to be satisfied or any one condition to be satisfied to classify under those levels for the previous question. Continuation.
No, for the previous, no, is this related to rounding off? No, rounding off is a different question. If I understood, it is for classification of level 1, level 2, level 3. Each of the conditions stands alone. It is not cumulative condition, which means if someone satisfies even one condition, they will be under level 1, level 2, level 3. They need not satisfy all the conditions to become level 1. Any one condition is enough for them to get covered under the respective levels.
Shall we close?
Yes, sir.
Okay. Sir, thank you very much for the lucid presentation, and the topic looks to be so long. The title of the days, this one, but it is very simple for your this one. Only classification is the main, and what are the standards applicable. And despite that, you have covered even the recent publication of the Institute on financial statements for non-corporate entities also. Thank you very much for your time and efforts in taking up the topic for the day. And I also thank all the participants, despite the tax audit busy. You have participated, and this is kept during this season only because to facilitate the doubts that are there on these things. I think you covered even the mandatory requirement of this accounting standards, sir. So only I think this financial statement format is not yet mandatory. Am I right, sir?
Yes, sir. The format is not mandatory, but the institute has recommended a format.
Yes.
And hence, they are welcome
Yes,
to follow the standard.
We invite all of you, and but it will be made mandatory before 25. That's what is the indication given by the VP recently in a webinar.
The only challenge there is that the ICAI's thing will be applicable for the auditors and not on the entities.
Yes.
So how do we make it applicable to the entities will become a challenge.
Yeah, you are right. So also all the standards and all these things, to what extent they'll follow and they're capable of writing the notes to accounts and all is a big question. Becomes
the only challenge for the professionals that I see here is on non-compliance with any of these aspects. No, the professional is supposed to give a detailed qualification or a
Yes.
detailed write-up on all those non-compliances.
Yeah.
Now, how it will be viewed by the business as a whole and non-corporate entities is a
Yes.
challenge.
Yes, yes, you're right.
That will be a practical challenge, but irrespective of it, any major change, as people would say, it will take some time for people to adopt, but they will adopt once they start seeing the benefits out of it. Now,
Yeah.
when banks start insisting this for their loan purposes, people
Yes.
will automatically adopt. So, moving forward, I think the people who will start adopting this will only go up, and over a period of time, we'll have those adoptions. And as I said, we are implementing almost 60 to 70% of these in terms of the standards and their applicability. We are already applying almost 60-70% of it.
Yeah,
So
yeah.
I hope the compliance will be there.
Yes, sir. Yes, sir. Thank you all the participants, and also thank you very much, sir, for the curtain raiser for of this 3-day workshop on non-corporate entities and their accounting and accounting standards applicable to them. So thank you very much, sir. I thank all the participants. Please, we'll meet tomorrow same time 5 p.m. For the second session of the series. Thank you all. Thank you.
Thank you, sir. Thank you.
Thank you, sir.
Thank you, sir. Close the session.